Hey everyone, we need to talk about what just happened to silver. And more importantly, who was behind it. Silver just experienced its worst two-day crash in 46 years. From $121 on January 28th down to $78 today, February 1st. That's a $43 collapse, a 33.5% wipeout in just 48 hours. If you were holding $10,000 in silver on Tuesday morning, you're looking at $6,600 right now. That's $3,400 gone, vanished. Gold didn't escape either, from 5,300 down to 47.45. That's an 8% haircut. But silver? Silver got absolutely demolished. But here's what mainstream media isn't telling you. This wasn't just a correction. This wasn't profit taking. And this definitely wasn't normal market behavior. Yahoo Finance just published a bombshell investigation with a title that says it all: How Chinese Speculators Set the Stage for Gold and Silver Crash. We're talking about a $9 trillion metal war that's been building for months, and it just detonated in our faces. This goes deeper than what you're seeing on the surface. Here are the three factors that converged in the last 72 hours to create the perfect storm that wiped out silver. First, Chinese leveraged speculation reached historic extremes in early January. Starting in mid-December 2025, Chinese retail investors poured billions into silver futures on the Shanghai Futures Exchange. We're talking about margin-fueled buying on a scale the market had never seen. Silver rallied from around $70 in early January to $121 by January 28th. That's a 73% move in less than 4 weeks. Here's why this matters for silver specifically. Chinese industrial demand already accounts for roughly 28% of global silver consumption: solar panels, electronics, EVs. But this wasn't industrial buying. This was pure speculation. Retail traders in China were using 20-to-1 leverage, betting that Trump tariffs and US-China tensions would send silver to the moon. The problem? When you're using 20-to-1 leverage, a 5% move against you wipes out your entire position. Silver went parabolic. It hit psychological resistance at 120, and then someone pulled the plug. Second, Trump nominated Kevin Warsh as the next Fed chair on January 30th. At 2 p.m. Eastern Time on Friday, January 30th, President Trump announced Kevin Warsh would replace Jerome Powell when his term ends in May. The market's immediate reaction? Relief that Fed independence concerns were easing. But here's what happened next. The US dollar index surged. It jumped from 108.5 to 110.2 in less than 3 hours. Silver and gold are priced in dollars globally. When the dollar strengthens, metals become more expensive for foreign buyers. Demand drops, prices follow. Chinese buyers, already sitting on massive leveraged long positions, suddenly faced a double nightmare. Silver started falling, and the stronger dollar made it even more expensive for them to hold those positions. Margin calls started hitting at 4 p.m. New York time. By 6 p.m., the cascade had begun. Third, COMEX raised margin requirements in the middle of the sell-off. This is the part that has traders furious. On January 30th, as silver was already plunging from 115 toward 90, the CME Group, which runs the COMEX exchange, raised margin requirements by 18%. In a normal market, you raise margins to cool things down when prices are rising too fast. But raising them during a crash? That forces anyone using leverage to either deposit more cash immediately or get liquidated. Most couldn't deposit more cash, so the exchange automatically closed their positions, sold their silver, pushed prices lower, which triggered more margin calls, more forced selling, a death spiral. By the close on January 30th, silver had dropped from $121 to $74, 31% in one session, the worst day since 1980. Now let me connect all three. Chinese speculators created the parabolic rise using extreme leverage. Trump's Fed chair pick strengthened the dollar and reversed sentiment. And COMEX poured gasoline on the fire by raising margins during the panic. The result? $9 trillion in paper wealth evaporated across precious metals markets in less than 48 hours. So I pulled up the data this morning, and here's what jumped out at me. The Shanghai Gold Exchange reported silver withdrawals in early January totaling roughly 26% of registered inventory. That's physical silver leaving the vaults. Chinese buyers were taking delivery, converting paper contracts into real metal. This drained available supply and amplified the squeeze higher. But when the reversal hit on January 30th, those physical holders couldn't sell fast enough. Physical silver doesn't trade in milliseconds like futures contracts. So the futures market, the paper market, crashed first, and crashed hard. Here's why this matters. The 50-day moving average for silver sits at $92. Silver closed Friday at 74, then bounced to around 78 to 86 today, depending on which contract you're looking at. We tested a critical support zone at $75, a level that held back in December before the parabolic move started. If this level holds through next week, we're looking at a potential double bottom formation. Historically, that leads to a recovery of about 15 to 25% within 30 days. But if it breaks, the next major level I'm watching is $68. That would represent another 12% move from current levels. At that point, we'd be back to prices last seen in November 2025, erasing 4 months of gains in 2 weeks. The RSI, Relative Strength Indicator, which measures whether something is oversold or overbought, dropped to 14 on January 30th. Anything below 30 is considered oversold. 14 is extreme panic territory. We haven't seen RSI that low since March 2020 during the COVID crash. What typically happens when RSI hits these extremes? A violent snapback rally within 5 to 10 trading days. We're talking 20 to 35% bounces. The trading volume on January 30th was the highest in recorded history for silver futures. This tells me this wasn't some low liquidity flash crash where a few large orders moved the market. This was genuine forced liquidation. Real sellers dumping real positions because they had no choice. This reminds me of September 1980, when the Hunt brothers tried to corner the silver market. They drove silver from $10 to $50 using borrowed money and leveraged futures. Then the exchange changed the rules mid-game, just like what happened last week. Margins were raised. Leverage was cut. The Hunt brothers couldn't meet the margin calls. Silver crashed from $50 to $10 in 8 weeks. Both times we saw the same pattern: parabolic rise fueled by leverage, regulatory intervention during the peak, cascading margin calls, and a violent correction. The critical difference today? In 1980, silver recovered to $15 within 6 months, then drifted sideways for years. It took 28 years for silver to revisit $50. That happened in 2011 during the sovereign debt crisis. But today's fundamental backdrop is structurally different. In 1980, there was no solar industry consuming 200 million ounces of silver per year. There were no electric vehicles requiring silver paste for every solar cell and circuit board. The world wasn't transitioning to renewable energy that depends on silver as a critical material. Today, global mine production is around 820 million ounces annually. Total demand, industrial plus investment plus jewelry, runs around 1 billion ounces. That's a structural deficit of roughly 180 million ounces every year. This deficit gets filled by recycling and above-ground stockpiles, but those stockpiles are finite. The pattern doesn't repeat exactly, but the sequence and psychology remain remarkably similar. Leverage-fueled rally, exchange intervention, forced liquidation, extreme panic, then recovery. Now let's talk about the fundamentals, the real supply and demand picture. According to the Silver Institute's latest report, industrial silver demand hit 610 million ounces in 2025. That's up 9% year over year. This is being driven by 3 unstoppable sectors. Solar energy. Silver paste is essential for photovoltaic cells. Every solar panel uses about 20 grams of silver. Global solar installations grew 38% in 2025. China alone installed over 300 gigawatts of new capacity. That consumed roughly 140 million ounces of silver, and that number's growing. Electric vehicles. Each EV uses about 30 grams of silver for circuit boards, charging systems, and battery connections. EV production hit 18 million units globally in 2025, up from 12 million the year before. That's an extra 55 million ounces of annual silver demand that didn't exist 5 years ago. Defense and electronics. With US-China tensions escalating, defense spending is surging. Every missile guidance system, radar array, and communications device uses silver for conductivity and reliability. That sector consumed 70 million ounces last year. On the supply side, global mine production hit 820 million ounces in 2025. Total demand was 1.02 billion ounces. That leaves us with a structural deficit of about 200 million ounces per year. Here's the critical part. About 72% of silver comes as a byproduct of copper, zinc, and lead mining. When those base metal operations slow down, which is happening now because of global economic uncertainty, silver supply gets squeezed even if silver prices are high. You can't just turn on more silver production without ramping up the primary metals. Now, China's 10-year government bond yield just hit 1.80% this week. That's near the lowest in over a month. This signals monetary easing is likely. When China eases, commodity demand typically increases within 60 to 90 days as stimulus filters through the economy. Let me put this in perspective. China consumes roughly 550 million ounces of silver annually out of global demand around 1 billion ounces. They're over half the market. When Chinese policy shifts towards stimulus and infrastructure spending, silver demand doesn't just increase, it explodes. We're talking about an additional 50 to 80 million ounces of demand that could hit the market between March and May 2026. Now here's what today's move revealed about institutional positioning. Central bank gold purchases hit 1,087 tons in 2025, according to the World Gold Council. That's the second highest on record. But here's what's interesting about silver. Central banks don't hold it. This makes silver purely a trade based on industrial demand and investor sentiment. According to Bloomberg, silver ETF outflows were about 90 million ounces during the crash from January 28th to 30th. During silver's rally from $70 to $121 over the previous 4 weeks, fund holdings grew by 130 million ounces. Let me break down what this means. Net position. Institutional money is still up 40 million ounces, significantly long. The big money hasn't capitulated. They've trimmed, but they haven't exited. But here's the interesting part. Retail investors and institutions are doing opposite things right now. Retail traders in China got wiped out. Margin calls forced liquidation. They sold at $74 to $86, near the lows. Meanwhile, institutional buying surged on January 31st and February 1st. Data from precious metals dealers shows physical silver coin sales in the U.S. jumped 68% over the weekend. Premiums on American Silver Eagles rose from $3 over spot to $7 over spot. That's a $4 premium increase in 48 hours. Smart money is accumulating while retail is capitulating. I want to share something Andy Schechtman, CEO of Miles Franklin Precious Metals, said in an interview on January 31st. He said, "We've never seen demand like this after a crash. Usually people panic and wait. This time they're buying the dip immediately. The phones haven't stopped ringing. And producers, the mining companies actually pulling this metal out of the ground, they're not panicking at current prices. First Majestic Silver announced they're reducing forward sales and holding more production in inventory. Compare that to today's $78 to $86 level. They see value here. They're not locking in sales at these depressed prices. They expect higher prices ahead. Speculators reduced positions by 42% in the week ending January 28th, according to CFTC data. They still hold 87,000 net long contracts. For context, at the peak in 2011, that number was 135,000 contracts. We're not at extremes yet. Today, flushed out weak hands, the over-leveraged Chinese speculators using 20-to-1 margin. What remains are long-term holders and value buyers. And what's potentially happening now is a shakeout before the next leg higher. We've seen this exact pattern before. Back in March 2020, during the COVID panic, silver experienced something remarkably similar to what we're seeing today. Let me walk you through how it played out. Stage 1, the parabolic rise, November 2019 to February 2020. Silver rallied from $17 in November 2019 to $18.70 by mid-February 2020. That's a 10% move in 3 months. It was driven by Federal Reserve rate cuts, safe haven demand as COVID fears emerged, and industrial buying ahead of expected supply disruptions. Sound familiar? Silver just moved from $70 in early January to $121 by late January, a 73% move in 4 weeks. Stage 2, the crash, March 2020. On March 18, 2020, silver crashed from $17.50 down to $12 in just 5 days. That's 31%. It was driven by a liquidity crisis. Everyone needed US dollars immediately. Margin calls hit. Forced liquidation cascaded. Even safe havens got sold to raise cash. Compare that to today. We just saw a 33% drop from 121 to 74 in 48 hours. Stage 3, the recovery, April to July 2020. Silver recovered to $18 by July 20th. It regained 33% over 4 months. Buyers stepped in at $12 to $14, seeing value. Physical premiums spiked to $6 over spot, just like we're seeing today with $7 premiums on Silver Eagles. Central banks announced unlimited QE. Stimulus checks hit. Industrial demand rebounded as factories reopened. Stage 4, the breakout, August 2020. In early August 2020, during peak stimulus uncertainty, silver made its final move, from $18 to $29.50 in 3 weeks. It was driven by inflation fears, dollar weakness, and a Reddit-fueled short squeeze. The complete journey. Silver went from $17.50 to $12.